Hey everyone, and thanks for jumping back into the cryptoverse. This is a premium only video. We have Taiki on the channel. He's going to generally talk about yield farming, earning interest on your crypto. We've spoken about it a lot on the channel. I've showed you some of the tools that I use, but I also thought it would be good for us to take a deep dive. He was on the public channel about a week ago or so, and so I would encourage you, if you haven't seen the public video, first go watch that one, and we'll link that in the description below. And then this one is just going to be for the premium list. So Taiki, it's a pleasure to have you on, and we're excited to see what you have to share with us today.
All right, cool. Thanks, Ben, for having me. So this is going to be the overview video. I went over in the public video, but I'll just briefly go over what yield farming is again. And I'll just briefly going over like a new way to think about your portfolio where you can think about cash as its own asset class as a part of a yield generating a part of your portfolio. And lastly, I'll be making an argument that in this type of environment, when we expect a sideways consolidation in the markets, this is like a perfect environment for stablecoin farmers to outperform the market to generate a yield on your assets. That being said, let's just go over the video. So, like I mentioned in the original video, yield farming is a way to generate high yield on your crypto assets. In other words, getting paid to use DeFi applications to bootstrap growth. So the thing I like to always talk about is the Aave partnership with Polygon. Roughly over a month ago, Polygon launched with zero liquidity on their ecosystem. So what they did was they partnered with a DeFi blue chip such as Aave and said, all right, everyone, we're live. We'll literally pay you to use the platform, so try us out. So that's essentially what I've been taking advantage of, where I'm being paid to borrow and lend on Aave. So as you can see, Aave is a borrowing and lending protocol with over $8 billion already in it, right? So it's a lot of people are taking advantage of these opportunities. And if you take a look at the USDC part, you see that on your dollars, you can earn 1.7%, paid in dollars. And you can also be paid Matic tokens, right, in the tune of 2.3%. And also, you're being paid to borrow because your interest rate to borrow is 3%, but you're being paid 3.5%. And there are other liquidity mining programs such as that I covered on the public channel, like Curve earning over 20% on your dollars, and SushiSwap earning roughly 15 to 20%. Okay, so I already went over the tutorial, so I won't cover it here, but I just want to introduce this idea of thinking of cash as a new type of asset class, right? And thinking about the role of stablecoins in your portfolio. Because I think a lot of crypto participants kind of look down on the idea of holding cash, right? Because
Mm-hmm.
with Bitcoin, it's like, I don't want to hold fiat, I want to hold a scarce asset like Bitcoin. But with DeFi, you can actually get your dollars to work for you and generate yield. So for me, stablecoins, it's a part of a yield generating part of my portfolio that can mitigate downside risk. And my favorite book growing up was The Little Engine That Could. But
Right.
Ben often talks about in his channel, about the well-oiled machine that could. So I'll be introducing like this concept of let's think about cash in a different way, right? Stablecoins in a different way. And if you're long ETH, you're essentially long DeFi because DeFi is the killer use case for the Ethereum blockchain. So if we expect a lull in the markets and for the next few weeks or months, why not take a small percentage of your portfolio and use and learn about DeFi? Um, so I was going to go over like the expected stablecoin yields in DeFi based on risk tolerance, and I'll also be comparing it to what you can receive at like a bank or a centralized finance company. So yeah, banks and BlockFi is like a crypto bank, right? It's a centralized finance company. And for DeFi, I have these like the different risk tolerances from conservative to just pure degen mode. So when I looked up the highest APY I can earn on my dollars, I found this Goldman Sachs product that gave me 0.5% APY. If you convert that,
No one's getting out of bed for that here, I guess.
yeah, definitely not. And if you convert that to the monthly rate, it's 0.04%, right? Because APY is compounded and 0.04% to the 12th power gets to zero point 0.5. And BlockFi, you can argue that BlockFi isn't very conservative, but I guess as a DeFi native, I think it's a very conservative way to generate yield on your dollars.
Mm-hmm.
Right now, it's earning 8.6% or 0.69% a month. And I think in DeFi, even the most conservative approach can give you 1% a month, right? Even the curve, the dollar form on curve is generating roughly 20%. And just looking at this here, I mean, like a bank, like on their best product will give you 0.5% a year. But with DeFi, you can earn 1% in a month, right? So just think about that and think about, okay, like cash is a yield generating part of my portfolio that can do so much for me. Moderate risk. I think right now I'm using a moderate approach that I'll go over later in the video where I'm earning 3% a month on my dollars. And that's 42% a year. If you want to take more risk, maybe 5% a month, 80%. And if you want to go full degen, you can definitely earn more than 10%. And this is what I did in the month of May. Uh, when I just went into these degen farms. I'm not going to go over too much, but there are ways to earn high APY on your stablecoins. And generally, on average, I deploy a strategy to roughly target 3 to 5% a month on my stablecoins. And if you think about it in dollars, literally the dollar I guess part of my portfolio is generating 40 to 80% a year, right? This is unheard of because the S&P 500 on average returns around 8 to 10%. And with DeFi, you can earn 40 to 80% on dollars. So I think that's something that's a lot of people overlook because crypto, I think people get drunk on the idea of things that can move 20% in a day and kind of forget that dollars can earn a lot in DeFi.
Yeah, look at the last month, right? When the market was moving up, this is when I kept saying, hey, I'm taking some profits back to stable coins. But at the time, no one's really interested in stable coins because
exactly,
why would I sell when everything's just going up? But then the minute the market dips, everyone wishes they had more dry powder to put into the market. So the great thing about this is not only is it's completely in line with the strategy of taking profits out into stablecoins. That doesn't mean you have to stop making money. It just means you make it in a different way and you just offset some of your risk somewhere else. So I think that's the key thing to remember is that stablecoins can work for you, in a really positive way.
Yeah, exactly. And on my YouTube channel, my public YouTube channel, I made this video where I essentially turned $17,000 to $35,000 in the month of May, and this is like you said, I did this when the entire market nuked. So obviously, when things are going up, it's why would I want dollars? But when it goes down, it's oh, I wish I held more dollars.
Right.
And I don't want to. So this is the type of degen yield farms that I was part of. Not gonna I don't endorse this project, but it's simply an example. But these degen yield farms they have a lot of money locked into them, right? This one in particular has over $250 million locked, right? And these yields have been sustainable in the past 6 weeks. I can't say if they will be sustainable in the future, but roughly 350% APY. That's something to get out of bed for.
Well, I know what you're talking about because so at the conference, the Bitcoin Miami conference, I've spoken to a lot of people that were there. There's actually a ton of people in the DeFi community, DeFi. They're chasing these yields. So, a platform launches, they incentivize you to go there by offering these really high yields. And people are just jumping around from one of these platforms to another every 2 weeks. And some of these guys are earning 1% a day. It's ridiculous. I'm not endorsing it because the hard part is actually vetting the code. And a lot of these guys are actually, they're going through, they're vetting the code, they're making sure, hey, what are the vulnerabilities? I've heard that some of them will literally just diff the code between that and maybe Pancake Swap to see what are the differences, are there any vulnerabilities or not. So essentially, you have this money ball moving from one platform to another, chasing that really high yield. And if you go back to that last chart you just showed, this is what here. What caught my eye was this. So what people are doing, and I'm sure you're fully aware of this too, but I've noticed what people are doing is they're going to these yield farms. They're putting their yield into a fairly stable pair, something that's not, that you're not going to have a ton of impermanent loss on, right? There's a lot of liquidity on it and whatever. And then they're farming the native token of the platform. But then they're just dumping it, right? They're just dumping the native token because no one cares about it. You just, you're basically just sucking the yield dry. And then you just move on to the next platform. So the platforms are learning what's going on. So you see the deposit fee. Look at the deposit fee. So now, when you do it, now they're also having these deposit fees because well, we don't want this guys to just come completely suck us dry. We also want to make money. So now they're taking a deposit fee. So I guess the idea is if, you deposit, say, a few $1,000s, you're paying a few $100s just off the top to the platform. You can go earn the high interest rates, but you have to really vet the different platforms. This community is just ridiculous the more you dive
Yeah.
into how crazy it is. But I would also caution people to be incredibly careful because there are some that can rug pull, and that's
Yeah. Yeah.
why
Yeah.
that's the reason why vetting the contracts, vetting the platforms and whatnot is key to being successful, I think.
Yeah, and it's called farming and dumping. That's essentially what I've been doing, like in the early parts of May, where I just farmed these tokens that I didn't think was worthless, and I just bought Matic with it, right? And I
Right.
was able to capture like the run up from like 50 cents to 250, and that's why I was able to essentially farm and dump these tokens, accumulate an asset that I actually want, and if it goes up,
Well,
then
that's
like
essentially what Sushi Swap did. I mean, they basically just entice people with really high yields for a while to get them to the
yeah,
platform.
yeah.
But then, like the super smart investors, they don't stick around once the yields go down. They go find the next highest yield somewhere else.
Yeah, yeah, exactly. So, yeah, I don't really endorse any of these like crazy yield farms.
Yeah.
But I do take part in them when I do think that I can make money from them. Um, but then, that being said, I guess whether you want to take on a lot of risk or even little risk, I do think my thesis and I think Ben's thesis as well is that we're going to enter a lull in the markets where we just consolidate for a while. And I think it's a great time for you to at least like look into DeFi and try using it and get your dollars to work for you. Because I do think stablecoin farmers will outperform the market in that sense. So this is like a little quick thought experiment that I guess like tell like my audience about. It's like how would like an 80-20 portfolio of like 80% crypto and 20% cash perform compared to a 100% exposed portfolio
Right.
under the following circumstances? A V-shaped recovery sideways or just continued downtrend. And if you're optimistic, maybe you say there's a 33% chance of all these things happening. Well, the stablecoin farmer will or the 80-20 portfolio will outperform in two-thirds of the scenarios. And maybe this is more likely, right, given what we know about the market now. But in this case, three-fourths of the time, stablecoin farmers
Right.
outperform. And I mean, it doesn't matter like what these numbers are; these are arbitrary. But I do think that farming with stablecoins, or at least like allocating a percentage of your portfolio in stablecoins and farming with it, will allow you to play from a position of strength in case the market does keep going down, or in the case like the market does go sideways. Because if you're earning a yield, then whenever you want to buy like your favorite crypto asset, you can buy more of it, right? Because you're generating a yield on your dollars.
Right.
So crypto doesn't have to be buy something and hope it goes up. You can actually get your dollars to work for you. I mean, no one's getting out of bed for a 2x in 3 years, but $1,000 earning 2% a month can like double your money in 3 years.
Yeah, well, it's all
Uh,
about just offsetting your risk and just one more way to set yourself up no matter what happens, right? I mean, it's hard to know what's going to happen in the short term, whether it's going to be a V-shaped recovery or something else. I mean, as the weeks go on, you have to start to wonder, well, at what point can we say it's not a V-shaped recovery? If it goes sideways for 3 months and then goes up, it's certainly not a V-shaped recovery.
yeah,
So I agree. I mean, it's basically just one more way to earn money in crypto, and it allows you to do it in a you're taking on I mean, I don't want to say you're completely de-risking because you are just taking on like a different type of risk when you
yeah.
yield farm, but certainly keeping a lot of it in stable coins is great because then whenever the market hits those risk levels you want to buy in, you have so much more money than you would have otherwise had if you just had it sitting in some bank account.
Exactly. Yeah. And yeah, so stablecoin, like this idea of farming opens up a whole new world of portfolio theory, not to mention the added benefit of using to understand DeFi. Because this is my thesis, but I think with Bitcoin and ETH, understanding it was like the retail investor's way to front run institutions, right? The smart money. But I argue that the next large wave of institutional flow is going to come in DeFi, and this is already happening. Today, it was announced that Spartan Group, which is a DeFi fund, raised $100 million. Last month, Framework Ventures raised $100 million. Andreessen Horowitz, they announced $1 billion crypto fund. Carl Icahn like said in like a Bloomberg interview like a few weeks ago that he's thinking about going big into crypto, and he mentioned Ethereum, and
Kevin
I'm assuming
O'Leary.
he's
Kevin O'Leary just launched his own DeFi platform, I believe, as
yeah.
well.
Yeah, exactly. So the institutions are coming, right, and they're probably already here, but I think that more institutions will come in the future. In fact, like I talked about Aave, like they already have this permission pool for institutional investors to test the waters. Stani Kulichov, who's the founder of Aave, said that this is a private pool for institutions that are still practicing before aping into DeFi. So this is like the similar concept that I talked about. It's like just try out these safer DeFi applications, and then if you feel comfortable with it, maybe you can go out the risk curve to generate more yield. But yeah, just try out DeFi because this is a chart that's like astounding, but like the stablecoin supply is literally up and to the right, right? It's mostly Tether and USDC, but we don't know like what's happening with these stablecoins. Like maybe it's used to buy Bitcoin, but I think the majority of it or a bulk of it is going into these like yield opportunities by institutions. And I guess Ben doesn't talk about the F word in his channel, the fundamentals.
Occasionally, but we don't get too carried away.
Yeah, but this is like the decentralized exchange volumes by project. The pink one is Uniswap, and there's so much volume going through Uniswap. I mean, Uniswap sometimes does more volume than Coinbase, which is incredible. And these are cash generating platforms, right? So some of these protocols like generate more cash than most public companies, right? So I do think that these institutions, they're going to be interested in this like cash generating protocols, and I do think institutions will like keep investing into DeFi, and I do think we're still early. That being said, like I mentioned in the public video, I think Polygon and Matic is a good way to test the waters because the ecosystem has essentially zero transaction fees, so you can still like try it out. That being said, I want to wrap up the video by going over like the former mindset of using dollars to accumulate a speculative asset. Okay, so I'm not shilling this project by any means. I have no idea if it'll work, but there's this project called DeFi, which is a multi-chain DEX, and conceptually, like it sounds pretty cool. They're essentially how it works is that they're putting nodes into different chains like Avalanche, Polkadot, etc., and Ethereum, and you can perhaps at one point when their ecosystem is more built out, purchase assets on different chains like using Ethereum or Matic, right? And you can see like they're trying to build nodes on BSC, Polka, Avalanche, etc., and they're backed by pretty famous investors or like funds such as CMS, Rarestone Capital, QCP, etc. For me, like I'm more risk averse in nature, and I don't really want to buy like this token with my own money, just because like it would not surprise me if this thing goes to zero like next month.
So
what I choose, yeah. So what I chose to do was I decided to farm it. Right. I want to farm this asset instead of just buying it outright, and I want to use the DAI USDT pool. So I'm providing liquidity for stablecoins, so no risk for impermanent loss, and I'm not taking on like volatile crypto asset risk. And I'm earning roughly 51% or 52% now, earning 7.8 DeFi in a day. So I've been doing this for like 2 weeks, and I'm already at like 100, right? So this is a way like the idea is that you don't have to buy an asset to like dump immediately or to like hope it goes up. You can just farm it with stablecoins. And I guess going over like my playbook is that this is like my Aave portfolio where my collateral, like 2/3 of it is in like stablecoins, right? And also like Bitcoin is also roughly 19% of my collateral. I want my collateral to be relatively stable because if it goes down too much, then I might get liquidated, and I'm also borrowing stablecoins against it. So what I did is I borrowed $8,000 worth of DAI, right, which is essentially a free loan because my interest rate and rewards rate is the same. I also borrowed $8,000 worth of Tether, right, being paid to do so. I'm paying 4%, but I'm earning 8%, and I'm putting it in this liquidity mining program, like providing liquidity and earning yield, right? So this is like how a lot of people like think about like farming assets. And if you think about it, like if you buy like this token like in the open market, you're effectively being diluted because people like me, we're just farming it for free with stablecoins. Right. And I feel like 90% of crypto assets are inflationary, right? So like even Bitcoin, which is like a scarce asset, I mean, there's new Bitcoin being mined every single day. Mm-hmm. And the idea is that, if you hold a crypto asset on a centralized exchange or on a centralized exchange, it's safe, right? Like I don't think Coinbase is going to get hacked or, at any point in the future. But, if you're holding a coin on a centralized exchange, it's a stagnant token. It's not generating yield in any way. And as these as these liquidity mining programs have shown, these protocols are minting new tokens to, incentivize people to use them. So if you're holding Sushi or Matic, I mean, it can go up, obviously. I mean, Matic went from like 30 cents to like almost $3 in like a month. But it's like a new way to think about crypto. It's like, okay, I can either just hold it and not generate yield, or I can put this into BlockFi or some DeFi application and generate yield with them. So I actually have this. I made this like public guide, like a free guide to yield farming, and I'll put this in the description below as well. But if you're new to DeFi, I kind of go over like the steps, like download MetaMask. Like I have all the links provided, so
Right.
no strings attached. So I'll share this with. Oh yeah, we'll put this in the description below, so
Sure.
you can think about like how to do it. So yeah, that's the end of the video. Do you have any questions?
Yeah, so I mean, like this is, I mean, because of the the implications of everything. I mean, this is one of the reasons why we're going to be covering Matic on on the channels. We're going to add it to the risk dashboard. We're going to add Aave to the risk dashboard, maybe a few others as well. But it really goes to show how powerful yield farming is, right? And from when I've spoken to a lot of people at the conference. It seems like a lot of older people are more interested in like like just Bitcoin, being sort of like Bitcoin maximalist kind of thing, where it's Bitcoin and nothing else. But then a lot of the younger people are just super like in love with DeFi, right? Because it's like you see the potential of it, and it starts to it makes things like traditional bank accounts look kind of ridiculous. I mean, even a centralized platform like BlockFi or Celsius Network or something, um, they already make bank accounts look kind of ridiculous when you're just getting those yields. And in DeFi, obviously, it depends on what your risk tolerance is. I mean, I've toyed with it myself, and going after the higher interest rates certainly come with their own risks. So we have to we have to say that for sure. If you go
Yeah,
down the rabbit hole for yield farming, just know that your risk probably scales exponentially as you go for higher yields. I know people who don't even bother yield farming for anything less than 100%. Like I know people that do that. But they also are spending hours and hours vetting the code. They're not just like blindly going to Reddit or something and finding whatever the new yield farm is and then just trusting it with their money. They're spending a lot of
yeah,
time figuring out, okay, well, can I farm this? And by the way, right, if you're probably going to only see more of these places pop up over the next few years. Like only more and more of these places are going to come, these decentralized exchanges. And I think a popular thing, as I mentioned earlier, is that people are yield farming. They're just doing it via stablecoins, as you showed us, and then they're just dumping the native token. So be aware that some of these platforms, when you deposit money, as you showed earlier, they will require that uh, deposit fee.
yeah, yeah,
And I think too, I think as people really build out whatever their well-oiled machine is they really should spread their risk around. Having some on a centralized platform to me makes some sense, right? It really does make some sense to have some on a centralized platform as long as it's like a trusted platform and it's backed by people with big pockets. Okay, like there was a time where Binance got hacked. I mean, a lot of exchanges have gotten hacked, but because they're so big, they're gonna take that. They absorbed that themselves. They didn't make the customers pay for it because then it would kill their exchange. So I think that spreading the risk around and maybe even having some that you're not doing anything with, you just have it tucked away somewhere, stored in a safe location, you're not doing anything with it. But then having some on centralized platforms and then really exploring DeFi. And if you are new to DeFi, I would encourage you to start small, right? Don't just throw all your money into DeFi and then figure it out. Like start small, get comfortable with it, and then continue to expand out from there. Um, I don't really know that I have any more. I mean, you did a great job. So I think that there's going to be some people watching this video and they're like, all right, well, I'm not sure. Taiki covered a fairly extensively. He covered extensively kind of one of his strategies on the public video. So again, we'll link that in the description below. And then also he said he would provide that little write up as well. And we'll post that so
yeah,
you guys can see it. But I think this is a great thing that people should be exploring. And from a fundamental, the F word, from a fundamental perspective, it's another reason why I think this market cycle is going to go on longer than 2021. I mean, DeFi is not going anywhere. Institutions are not going anywhere. It's going to take a while. I think it's just going to take us a while. And then I think when we look back on this market cycle in the future, it's going to have appeared obvious all along. Like, oh, how could we have assumed it was going to stop, in May of 2021 or something, when it almost seems like it's just getting started to some degree. But with that said, I think there is going to be a lull in the market, as we've been discussing for a while, and the market has to adjust to whatever the new normal is.
Yeah, totally agreed.
But yeah, hey, it was a pleasure to have you on the channel. Hopefully, you guys watching this find value in it. If you guys do, let me know in the comments. Maybe we'll try to do more of this stuff in the future, more hands-on, practical applications. Obviously, exploring DeFi can be somewhat scary, but let me know what you guys think in the comments. I will see you next time. Bye.